You're overcomplicating entries. Right now, thousands of traders are staring at charts covered in indicators, drawing lines that only make sense to them, waiting for a feeling that tells them when to pull the trigger. And most of them will lose money today. But here's what nobody tells you about entries. There's one signal, one candle, one mechanical measurement that tells you exactly when to trade, and it fires in the first 2 hours of every trading day. No interpretation required, no subjective judgment, just a binary yes or no. This is the 5% rule, and it's about to change how you think about entries forever. Let me show you why most entry strategies fail. Traditional approaches rely on subjectivity, support and resistance. 10 traders will draw 10 different lines. Pattern recognition, that's just confirmation bias wearing a fancy name. Gut feel, that's gambling. The problem isn't that traders are stupid. The problem is they're using tools that can't be measured, can't be repeated, and can't be backtested. And the data proves it. Over 80% of retail traders lose money. Brokers in the UK and Europe are legally required to publish this statistic. It's not a scare tactic, it's documented reality. But here's what's interesting. The traders who win consistently, they're not using more indicators, they're using fewer. They're not making more decisions, they're making one decision, mechanically, at the same time every day. Stay with me because this is where it gets mechanical. The first 2 hours of the trading day, from 9:30 to 11:30 Eastern, account for roughly 35% of daily volume. This is when institutions execute their major orders. This is when the day's directional bias gets established. And this is when one specific candle formation tells you everything you need to know. After 11:30, the signal quality degrades, noise increases. You're better off walking away. Which means if you know what to look for, you can be done trading before lunch. Now here's the part that changes everything. The signal I'm about to show you isn't based on patterns or feelings. It's based on a simple mathematical threshold that measures conviction. It's called a pulse bar, and the rule is simple. A pulse bar is a 30-minute candle that closes in the top or bottom 5% of its range. That's it. No interpretation, no artistic license, just math. Here's why this matters. When a candle closes in the extreme of its range, it's telling you something specific. Buyers or sellers showed up with conviction. They pushed price and they held it there through the close. A bullish pulse bar closes in the top 5% of its range. Price opened, moved around, and then buyers drove it to the highs and kept it there. That's conviction. A bearish pulse bar is the opposite, closes in the bottom 5%. Sellers took control and didn't let go. This isn't about predicting where price will go, it's about measuring who showed up with force. And when you combine this signal with a credit spread, you're not betting on direction, you're betting on probability. The pulse bar tells you when, the credit spread handles the rest. Let me show you exactly how to identify this manually. First, you need a 30-minute chart. I use TradingView, but any platform works. Second, you need a Fibonacci retracement tool customized. Set your levels to 0%, 5%, 95%, and 100%. You only need to do this once. Now, here's how you use it. When a 30-minute candle closes in the first 2 hours of the trading day, you apply the Fib tool from the low to the high of that candle. The tool will show you the 5% zones at the top and bottom. If the close is inside the top 5% zone, you have a bullish pulse bar. If it's inside the bottom 5% zone, you have a bearish pulse bar. If it's anywhere in between, you have nothing. No signal, no trade. You wait. This is the power of objective criteria. There's no debate. There's no, well, it looks kind of bullish. Either the close is in the 5% zone or it isn't. But wait, there's a reason this only works in the first 2 hours. After the opening session, institutional order flow slows down. The conviction signals become less reliable. Noise increases. False signals creep in. That's why we only look for pulse bars in the first 4 30-minute candles of the day. 9:30, 10 a.m., 10:30 a.m., and 11 a.m. If nothing fires by 11:30 a.m., you're done for the day. And honestly, that's the best part. So here's the complete process. Step 1. Check the first 30-minute candle at 10 a.m. Eastern. Apply your custom fib tool. Did it close in the top or bottom 5%? If yes, you have a pulse bar. If no, wait for the next candle. Step 2, if you get a pulse bar, you know your direction. Bullish pulse bar means put credit spread. Bearish pulse bar means call credit spread. You set up the trade using the at-the-money structure we covered in the previous video. Step 3, walk away. The trade is placed. Time decay is working in your favor. You don't need to watch the charts. Come back at the end of the day or let it expire. That's the entire system for this setup. Now, I use software that identifies pulse bars automatically. It also applies additional filters, things like average true range, time of day, directional bias from the higher time frame swing, and it calculates what I call dynamic pulse bars, which adapt the 5% threshold based on current volatility. But here's the thing. You don't need the software to trade this. The manual method I just showed you works perfectly well. The software just makes it faster and adds some filtering on top. Today we covered one core setup from the SPX Income System. There are 6 more money-making patterns that build on this foundation, but they all start the same way, with a mechanical signal that removes subjectivity from the equation. And here's what my students discovered when they started using this approach. Let me show you what happens when you trade this way. In 2025, my community closed with a 95.3% win rate, 61 winners out of 64 trades. On the RUT Premium Poppers, we hit 97.4%, 37 out of 38 in a 30-day window. Jared grew his account by 37.4% since starting. Alan posted 8 wins and 2 losses in his first 10 days, up 19.5%. These aren't cherry-picked unicorn results. These are real traders posting real trades in my Slack community every single day. And the common thread? They stopped overcomplicating. They went from stacking 27 indicators and drawing subjective lines to waiting for one signal in the first 2 hours and walking away. That's the transformation, from chart zombie to systematic trader, from all-day screen time to 15 minutes and done, from hoping to following a process. The pulse bar doesn't care about your opinions. It doesn't care about the news. It doesn't care what you think should happen. It just measures conviction. And when you combine that measurement with a credit spread that pays you to wait, you've got an edge that compounds. Not overnight, not with one trade, but trade after trade, week after week, with mechanical consistency. This is what I meant in the last video when I said getting paid even when you're wrong. The pulse bar tells you when, the credit spread handles the rest, and time decay does the heavy lifting while you live your life. If this makes sense to you, and you want to learn the other 6 setups in the system, there are a few ways to go deeper. Drop a comment below with your questions. I read every single one. Shoot me a message, or check out antivestor.com, where I post my pre-market analysis and trade debriefs every single day. You can see this system in action live. Next time, we'll cover what happens when a trade doesn't go your way. Because here's the thing, with credit spreads, a losing trade isn't always the end of the story. Thanks for watching. I'll see you in the next one.